Hi friends, Jaik here. Welcome to the third video about my journey towards a 100k portfolio. Hopefully, you'll be able to take a similar journey towards your financial freedom. And for those who have achieved financial freedom, please share your success story in the form of a comment or a video. It'll be a great learning opportunity for all of us. And if you have some video or YouTube resources, please add that to the comments or share it with me. I'll share it with the others. Um, so a quick summary. I have 12% growth in my account. Portfolio summary. Portfolio is $57,998.54 as of May 31st, 2020. Compared to last week where I had a portfolio update, the portfolio is up by 4.92%. That is up substantially, guys. And 3.92 of that is from the stock market going up, and 1% is from selling covered call options. So in total, 4.92% gain. That is pretty substantial. If it goes like this, which it won't, but if it increases like this, I can hit 100,000 like in 2 months. But we all know that's not going to happen, right? I can keep dreaming. To classify my portfolio, I have 39 securities in total. So to split it among the types of securities and the geographical boundaries, I have 0.8% of my portfolio in international bonds, 1.28% in US bonds, 10.29% in international stocks, 82.5% in US stocks, which is the most substantial one. If you look at it, you'll see the overall value is 95,000. But please note that my account is still only 57 or 58,000 to round it. The rest comes from my Robinhood Gold margin account. I use that margin just for selling covered calls, and then 4.84% in alternatives, which includes money that I get from my covered calls. Then IAU, which is a gold ETF, and also some REITs. So if you look at this graph, you can see it's mainly weighted down by the US stocks. But if I remove that, US stocks is more like 60% of my portfolio. The remaining I just use it for selling the covered calls. Analyzing my bonds, international and US bonds. International bonds, I'll split that into the corporate bonds and the government bonds. I have BLV. BLV is the Vanguard long-term bond ETFs. It is a market-weighted index of US government, corporate, and international dollar-denominated bonds. It gives a dividend yield of 3.06%. And then I have VWOB. That one is the Vanguard Emerging Markets Government Bond. It tracks the market value of emerging markets sovereign debt, which is denominated in US dollars, and gives a yield of 4.89%. So you'll see the same thing repeated, VWOB here and BLV here. It just means that these funds, these ETFs contains both international corporate bonds and the government bonds. That's what it means. And then you'll see a smaller portion of VIG and VYMI. VIG is Vanguard Dividend Appreciation ETF. It tracks market cap weighted index of US companies that have increased their annual dividends for last 10 years, consecutive years. And it gives a dividend yield of 1.78%. And VYMI is Vanguard International High Dividend Yield ETF. It tracks market cap weighted index of developed and emerging markets, and they are expected to pay above average dividends over the next 12 months. This one gives a dividend yield of 5.05%, so it's a little bit substantial, but also a bit more risky. Coming to the US bonds, uh, again, it's primarily based on BLV, both the corporate and the government bonds. So if you look at it, if you just have to choose one bond, right, you want to cover all of this, and you just want to have one bond, BLV is a very good ETF to have. So you'll have some US government bonds in it, corporate bonds in it, international corporate and government bonds. If you see BLV here, BLV here, BLV here, and BLV here, and it gives a dividend yield of 3.06%, guys. It's really good for someone trying to get into these bonds, which are kind of quite secure. And think of it. Let's say you earn, you accumulate like 100,000 worth BLV. At this point, it gives 3% yield. But over the years, for someone who has invested like 100,000 in BLV now, 20, 30 years from now, when you are about to retire, first of all, you don't have to sell these bonds, funds, because they are very secure. And by that time, your personal yield would be like 6 to 9%, and that would be just enough to retire. Think of it, if you have $1 million worth of it at that time, if it's like 9% yield, you're going to get almost 90,000, 100,000 bucks for $1 million spent in BLV. So it's a very good ETF to have. Coming to my international stocks, I can split that into emerging markets and the developed market. So if you look into these funds, you'll see that I haven't invested directly into too many stocks. Rather, I have invested in ETFs which tracks the index or market in certain countries. So I've primarily invested in China and India. Soon I'll add Brazil to this mix. So the first one in the emerging market, I have MCHI, which is the iShares MSCI China ETF. So iShares, I think it's by Blackstone or BlackRock. I think iShare is promoted by BlackRock, and it's based on the Morgan Stanley Capital International Index, MSCI, and this tracks a cap-weighted index of investable Chinese shares. The fund stretches across all market cap sizes and gives a yield of 1.53%. Then I have INDY. Again, this is an iShares India 50 ETF. Tracks a market cap-weighted index of 50 blue chip companies traded on the National Stock Exchange of India, and gives a dividend yield of 0.78%. The next one is INDA, iShares MSCI India ETF. This one tracks a market capitated index of the top 85% of the firms in the Indian securities market, gives a yield of 1.27%. And then I have a small position in Baba, which is Alibaba. And I'll slide, again, I have the VYMI in this sector as well. So if I zoom in a little bit, you can see the other mates. Mostly you'll see a mix of REITs, Noble, SREIT, FREL, which we did mention in the last video. So these are the other ETFs that I have, which in turn is based on the international stocks. Coming to the developed market, it's primarily based off VYMI, which we did mention a little bit before. And if I zoom in a little bit, you can see the different ETFs that I have within that fund. Most of them are much smaller positions. You can look at the dollar amount and see how small positions these are. But I plan to increase this substantially over the coming weeks. Going back to US stocks, I have I'll split them into large cap, core stocks, and growth stocks. In the large cap, I have JP Morgan. I primarily use JP Morgan. I have a small core position. It's only like 10 stocks. The rest I use for covered calls. Then I have Disney, which is my large cap. I think I have 77 or 78 stocks here. Before I had like 177. I sold 100 of them. And Home Depot. In the large growth stock, I have Microsoft. I think I have 270 stocks. Of that, I keep 170 of the stocks in my core portfolio and use 100 for selling a covered call option. So some of the ETFs that you might see in this, which I have been mentioned before, you'll see VNQI, which is the Vanguard Global outside of US real estate, basically global real estate. It tracks a market cap weighted committee selected index of non-US real estate, primarily REITs, and it gives a dividend yield of 9.79%. Also SRED, which we did mention in the last video. I have VNQ in here as well. VNQ is the Vanguard US REIT fund. It tracks a market cap weighted index of companies involved in the ownership and operation of real estate in the United States. Gives a yield of 4.10%. Another one, guys, which might be of interest to you, are my alternatives. So we just quickly went over the REITs ETF here. So I'll move over to the gold I have. It's IAU, it's a iShare Gold Trust. What it does is it tracks the gold spot price. So they actually physically stores gold in vault all over the globe. At least that's what that's what they say they do. And so every month they charge us for those operating expenses. So you'll see a small amount of money deducted from your account every month for that storage and all those operation expenses. But this is a good alternative to buying physical gold, where you have to spend money getting a safety deposit box in a bank, and you have to pay for it. If you keep it in your home, thieves can come and steal it. It's not secure, right? I mean, gold is valuable. So this is a good way to hedge yourself. So initially when I started my account, my idea was to have not to have cash in my account, but rather IAU, 20% of my portfolio. So I started like that. I had 80% equities, ETFs, everything, and 20% IAU. The idea was whenever the market drops, of course, normally the gold goes up, and hypothetically, let's go back to March 23rd when the market crashed. That day my IAU position was like up by almost 30% by that time. So ideally, if that my portfolio had 20% of IAU, that IAU would have grown. So let's say it was it grew by 30%. That's like almost $8, 8% of the overall portfolio value. So I could have sold my entire stake in IAU if I had actually 20% by that time. By that time, it only accounted for like few percent of my account. But as I originally started, and if I kept that ratio until March 23rd, I could have sold all my IAU, so I'd have a bunch of cash which had appreciated, and then I could have used that money to buy stocks in the cheap. So that's how you can hedge your account, and this is something which I'll do in the future. So slowly grow your positions like this gold ETFs over time, so that it reaches 15 to 20% of your account, and you don't have to keep cash, right? Because cash don't appreciate, but this thing, when the market crashes, will appreciate like crazy, and then you can just sell them, and with that money you can buy stocks. Now, why do you do that? Normally when the market crashes, the last thing we have with us is cash. So this is a good way to hedge yourself. So if I classify my portfolio in terms of the US sectors in which I've invested, Uh, as you can see from this graph, it's mainly in technology, so that's why it's heavily weighted in Microsoft. So that's why the technology is almost 40. Let's say this is 46% of my account, and the second one is the financial services, almost 30%, which is primarily due to JP Morgan, and it's really for covered calls. And then that it's kind of evenly distributed. You'll see communication services, consumer defensive, cyclical, energy, healthcare. I have a bit of everything. I don't think I have anything in basic materials. Maybe I should add a little bit to it. But if you look utilities and basic materials, the small amount I have, it's primarily from some of the ETFs that I hold. And that's all I have for you today. Stay safe and stay awesome, my friends.